Welcome to episode 2009 and greetings again from Budapest. Last time I addressed you, I was in my hotel in Budapest, but now I have moved on to the cruise ship. I'm on phase 2 of my European journey here for this trip. It's a long trip, over 5 weeks this time. And of course, phase 1 was yacht week with a bunch of friends in Greece. Then they all departed, went their separate ways. Phase 2, my mom flew in and met me in Budapest. And that's where I am now. We toured around town for a couple of days and saw some of the sights. This is my third time in Budapest, but it was her first time. And now we are on a river cruise where we will cruise up the Danube River and do that for about the next week or so. And it's my second time doing a Danube River cruise, but the first time for her, and she really wanted to come to Budapest. So that is what we are doing. So we've got a lot of stuff to cover today. If you're watching on video, you do see Budapest in the background. We are at the dock though, so that's where you get a stable Wi-Fi connection. Again, this is an absolutely stunning, spectacular city. Maybe I'll share some pictures or in video. You can follow me on Instagram for most of that, just Jason Hartman 1. Jason Hartman 1. You can see a lot of my travels, personal life, all kinds of stuff like that. You know, I'm sort of an open book. So, you know, personal and business kind of blend together in my world. They always have. But hey, we got a lot of stuff to cover today. So first of all, I want to start with a very quick thought on artificial intelligence. Of course, we have all been amazed by the company OpenAI and ChatGPT and their large language model, the LLM. And this is a game-changing technology. It really is something that is massively changing the world, and we ain't seen nothing yet. But really, I have a question for you. What will this mean for the future? You know, normally when there's some issue, some development in the world, if you've been following me for the last 18, 19 years, you know that I usually have a pretty strong opinion about it. And while I have a lot of strong opinions about a lot of things, when it comes to this type of technology, honestly, I am struggling to figure out what it means for our future, for the future of humanity. You know, there are a lot of different thoughts on the job losses that will come from artificial intelligence and other technologies. There's a lot of talk about the jobs that will be created or the prosperity that will be created because of the massive efficiency gains and so forth. I'm really struggling to figure this out and put it together. As I've talked about before on the show, the only job, according to the Bureau of Labor Statistics, the BLS, the only job category that has actually been eliminated by technology, and I think, what is it, the last 100 years or something like that, is one job. Only one job has actually been eliminated. And it's kind of funny to even say it, because I actually saw one of these people not too long ago on my travels when I was in Japan. This job wasn't completely eliminated, I guess, but mostly it's eliminated because we do this ourselves nowadays, right? You know, we pump our own gas. We didn't used to do that. We used to pull into the service station and someone used to pump our gas and change the oil or check the oil and wash the windows and, you know, put air in the tires and all this kind of stuff, right? So we do that ourselves. And so, you know, gas pumper has been eliminated, right? But that's not what I was getting at. There's still a few people that actually do that. But the job that's been eliminated is elevator operator. Yeah, we do that ourselves nowadays too. We get into the elevator and we push the buttons ourselves. So that job has largely been eliminated around the world. But what will AI mean? I mean, what will it mean for us, for our tenants? Will our tenants keep their jobs? When it comes to writing, for example, you know, we've spent an absolute fortune over the years in my different companies hiring writers to write things, to write newsletters, to write blog posts, to summarize my podcast and YouTube videos. That whole field has really been impacted in a huge way by specifically the LLM AI, the large language models, because now computers can do what they've done for a long time very well with math, right? Calculators, spreadsheets, etc., right? Can figure out math very well, but now they can figure out language very well, natural language language. And so this is a sea change. They can figure out how to write code and do programming. And so what does that mean to all the code writers, the programmers? It certainly allows one person running an AI program or system to do what thousands and thousands of people did before. So it massively increases the efficiency and the scale. So, what does this all mean? I mean, some of my most libertarian friends who don't want much government at all, they want extremely, extremely small amounts of government. Even they have been saying for several years that we need, or it's just a fait accompli, to have universal basic income, UBI. And of course, we had presidential candidate Andrew Yang on the show before talking about UBI, universal basic income, because the massive amount of labor turmoil that is coming our way is really going to impact society and riots in the streets. Who knows? Austerity measures, not sure. So that's kind of phase one of the technological change. And in many ways, it's deflationary. Remember, I've always said there's this, when we talk about inflation or deflation or stagflation over the coming years in the future, there's this war, right? It's a war between the deflationary aspect of technology and the inflationary aspect of bad monetary and fiscal policy. And so these are butting heads, these two huge forces, right? You print money into oblivion. Thank you, Jerome Powell, Janet Yellen, Ben Bernanke, Alan Greenspan, and many before, except for Paul Volcker, okay? Other Fed chairs over the years and the chairs of other central banks around the world, right? They have created so much currency, so many currency units that's very inflationary. But technology and all of the benefits of it are very deflationary because it just has such massive scale. So who will win the war? I don't know. I think personally, inflation will be the winning thing because that can just go to oblivion. Now, technology, it's also been incredibly impressive, but it is limited by the evolutionary aspect, right, of what we can figure out, what we can do with technology. But there is absolutely no limit to the amount of money they can create out of thin air. And if we get universal basic income, think about how do we pay for that, right? We have to pay for it by creating more fake currency units out of thin air, more inflation, more inflationary pressure. So we'll see who wins this. And I'll leave this AI topic here in a moment. I don't want to talk about the real estate market much more specifically. But the phase one of a technological change is initially job displacement, unemployment. Okay, so that's happened throughout history. We've seen it over and over, whether it be the cotton gin, the steam engine, whatever it is, right? Whatever technology, initially that displaces people, but then those people find a way to use those efficiencies and create other value in the system, in the economy. And humans just start expecting more and more. And they expect to benefit from the new technology, and they do. And so that creates more prosperity. And then humans figure out new things to sell to people, right? And thereby increasing the size of the economy. So we'll see how this goes. But what I'm really asking for here is your opinion. I would love your input on this very complex subject and what the future holds with artificial intelligence and technology in general. All of these amazing breakthroughs that we are experiencing so quickly. So if you're watching on YouTube or any video platform, Rumble, whatever, Odyssey, comment below. Okay, please comment. I love your thoughtful comments. We have very intelligent listeners and viewers in our audience. And so I would love to get your input. If you're listening on the podcast, just go to jasonhartman.com/ask, jasonhartman.com/ask. And tell us what you think about this, right? I would really love to get more input from our audience on this. And this article up on the screen is just a snippet from one of my newsletters. OpenAI CEO Sam Altman, who, by the way, is probably going to become one of the richest people in the world in very short order, testified before Congress on Tuesday addressing concerns about the potential impacts of generative AI tools. So generative. right? We hear that word a lot nowadays, right? What it means is that these tools like ChatGPT generate things, right? They generate things off very limited prompting. And the whole new field, by the way, it is prompt engineering, right? That's a new skill. And I've been talking about that since December of last year because ChatGPT launched on November 30th of last year. And so this prompt engineering talent or skill, right? This new skill set that we all need to develop to know how to prompt the artificial intelligence is becoming really important. So that's like a whole new industry. I mean, there are educational products you can buy about prompt engineering. I get emails all the time. Friends of mine who are in the marketing business, they're developing courses and communities around prompt engineering, right? So, one thing disrupts and puts people out of work, but then it creates a whole new thing. And so there's just like no limit to the number of new things that can be created because human beings have literally insatiable, unlimited wants and needs, right? There is no limit to what we can think of that we must have. It's amazing the ways we can figure out the new things we desire with our covetous nature and the new things we're willing to spend money on, right? So let's see where this goes. Please comment below if you're watching on a video platform. If you're listening on the podcast, jasonhartman.com/ask. This is going to be really interesting. It is a pivotal time in history right now, folks. All right, let's talk about the market a bit. So this article from Housing Wire is pretty interesting. It says, from ice bath to bloodbath, California, and this is not just California, but the spotlight happens to be on California because the company that is discussing it, who's been a former guest on the show, Altos Research, Mike Simonson, is based in California, right? It says California struggles with inventory. Local real estate agents basically are saying that the housing market feels like a cross between 2007, the Great Recession, when it comes to transaction levels, and 2020, the first year of the COVID era, with competition levels. Okay, so what does that mean? It means transaction levels down, but competition levels very high. Very limited inventory and a lot of competition for that inventory. I know this flies in the face of the just frankly clueless doom and gloomers who, are the crash bros, who are the people that saying the market is crashing and all this stuff. It's just not happening, folks. It's just not happening. Of course, there have been times in the market, and remember, you're looking at a lag, and I'll just tell you from our own business, right? In my companies, when the interest rates spiked, we saw about 2 to 3 months of slowness. And after about that 3-month mark, even though rates were higher, affordability was down, everybody figured it out. We've still got to do something with our money. What are we going to do? There's all this money sloshing around the world, right? And people have to invest it. And they always ask themselves the question in some form or other, which is the Jason Hartman question, compared to what, right? And so as they're asking the Jason Hartman question, compared to what, they think, well, what is my TINA? What is my there is no alternative for my money? Well, what else am I going to do? Hey, real estate's not as good as it used to be. Sure, we all know that, right? But nothing else is either. I mean, what else are we going to do? It's still the most historically proven asset class in the entire world. And it's the most tax-favored asset class in America. It is the best thing. And now we're seeing all of the crash bro predictions that just didn't happen. And it's turned out to be a much better thing than so many people expected. Oh, by the way, we have to take a little intermission here because if you're watching on video, I'm in my stateroom here on the ship, and you got to see the dog behind me laying on the bed here. Look at that. Look at this pooch. Just there like the king, the princess that she is. Just chilling here on the bed. I had to just take a break for that, and it's funny. It's amazing when I travel with the dog, how many people just like on the cruise ship. it's the only dog here. Almost always when I'm on a cruise ship, my dog is the only dog, right? And so everybody just falls all over the dog, saying hello. Oh, I miss my dog. I wish my dog was here, and all that kind of stuff. So it's always great to have her cheering everybody up and being so fun. All right, back to business here. Sorry. The California housing market has been in the news a lot lately with the slowdown in transaction sides and sales prices below the 2022 and 2021 levels, right? Here, we're looking at a cyclical market where it has much more volatility because it gets out over its skis, the prices go up too fast, and then it falls. But even a cyclical market is showing a surprisingly high amount of strength. Now, you take that to a linear market or a hybrid market, like the markets we recommend, and you're dramatically better off than you are in any cyclical market like California, like the expensive northeastern markets, or anywhere along the Pacific coast or the Atlantic coast, higher end markets, right? And that's what you have. Oh, there's some stats about transaction volumes and so forth. Oh, here's an interesting quote. Last time this year, inventory was rising super quickly as demand was starting to cool off, Mike Simonson, president of Altos Research, says. Quote, any potential sellers in 2022 were rushing to get to the market before the big catastrophe hit, and everyone could see that coming, right? But it didn't happen, right? For Simonson, the big catastrophe last May, right, was the impending Federal Reserve interest rate hike. The rate hike came in mid-June with the Fed raising rates 75 basis points, the largest single rate hike since 1994 in an attempt to help curb inflation, right? While inflation has continued to plague the U.S. economy, the Fed's rate hikes through the second half of 2022 had a chilling effect on the housing market, best illustrated by the dramatic downturn in sales. And this, folks, is one of the distinctions that people keep missing, and they just continue to miss it. Remember, I get an awful lot of feedback. I get critics. I get people that agree with me, that disagree with me, right? But one of the many mistakes a lot of these people tend to make is they conflate the idea of sales volume with sales prices. And those two sometimes correspond with each other, but sometimes they don't. And this is one of the times in this cycle that they do not go together at all, right? You can have a decline in volume, which many times, and certainly this time, is due to a decline in inventory. There's just no darn inventory, right? So of course, if you don't have inventory, if you don't have anything to sell, you're going to have lower volume. Most people misinterpret this, and they think the lower volume is a result of lower demand, right? And that is many times true, but it's not always the reason. Sometimes it's just lower inventory. When the market was just savagely hot during the COVID era, right, where there was like nothing to buy, there was multiple offers on every house, right? You just couldn't even operate in that market. It was awful, right? I hate that kind of market. We're almost in that kind of market now, but it's not quite that bad anymore. Thankfully, it's eased up a bit, and there is a little bit more inventory, but not much, right? It's just a little better, but demand has fallen off a bit because affordability is lower, and so now we're in a market where we can kind of operate, right? It's a better, much better market, in my opinion. Well, it's not my opinion. I mean, it's my experience, right? It's not an opinion. It's factual experience because I do it every day. And so we have that situation, and we see this issue of, we see lower demand because of inferior affordability, and we see low demand due to low inventory. So now it's kind of hit both ways, right? And that has caused a decline in sales volume, but not really any like real significant decline in pricing at all. But the other thing it's doing is, what about rents? The thing nobody seems to talk about hardly at all. I mean, when it comes to the real estate market, 95% of the discussion is about prices. Where have the prices been? Where are the prices now? What will the prices be in the future? Will housing get more expensive or less expensive in terms of price, right? But of course, people don't look at that in terms of payment like they should. But only 5% of the discussion about the market is about rent, right? Income, yield. Now, my 95.5 example here is just an example. I don't really know what everybody's discussing. That's just my estimate, 95.5. Okay, so don't hang your hat on it. Okay, but very few people are talking about yield and rent and income. And most people are talking about prices, where they've been, where they are, where they're going. And that is a huge mistake. You got to be talking about income if you are an investor. If you are a gambler or a speculator, then yeah, you're all focused on pricing. But that is an immature type of investing. It's not really investing, it's speculating. Okay? All right. So let's move on here and see if there's anything else I want to share with you in this article. Not too much, but I do want to share this chart because a picture says 1,000 words. And this is really, really important. So inventory, basically unchanged. It's about the same, about 420,000 homes for sale in the United States, in a country where we have about, the estimates vary on this, but somewhere around 120 to 140 million housing units. And of course, we have about 332 million people. Out of all of that, 332 million people, around, we'll call it 130 million housing units, we only have 420,000 of those for sale. That is nothing. If only here in Budapest, I had my little sound effect machine with me, I would make the bomb dropping and exploding sound effect, because that is an absolute disaster. There's like no inventory. I mean, there's just no inventory to speak of. It's incredible how low the inventory is. And if you're looking on video, and always, we have been doing a much better job. Thank you to Joshua and the team for getting these videos up faster on YouTube. So when you hear the podcast, you can go to YouTube or whatever. We're on a bunch of video platforms, Rumble and Odyssey and all the rest, right? When you go to any of these video platforms, you can go there, you can look at the charts and the graphs, you can take a screenshot of them and save them for later, show them to your friends, whatever. Or also be sure to subscribe to our newsletter. That is totally free. Just go to jasonhartman.com, fill out any web form, get on our newsletter list. We have some great articles and we put great charts in there and just great information for you. You might as well be getting our newsletter for sure. So comparing this to prior years, you can see, if you're looking at the chart, that there is just a massive, savage shortage of housing inventory. So you can't have a crash if you don't have a lot of inventory. Okay, switching gears here. I want to talk a little bit about adjustable rate mortgages for just a moment, because we have been moving into a market where adjustable rate mortgages are actually becoming much more attractive, and many more people are considering them as an option. So what do you need to know about adjustable rate mortgages? I want to just give you a very quickie lesson so that you can understand the way they work. With an adjustable rate mortgage, there are 5 major things that you want to know in terms of how that adjustable rate mortgage works. Number 1, you want to know, what is the start rate of that mortgage? Now, this is where most people stop, right? They look at the start rate and they think, okay, well, I'll take it, or I'm not going to take it. I'm going to go with a fixed rate mortgage, okay? But that would be a huge mistake, because that's only one of the 5 major factors. All right. Start rate. Yeah. Okay. If you can get a fixed rate mortgage and that's going to be 6.5%, and you can get an adjustable rate mortgage starting at 5%, which one do you take? Well, the answer is, I don't know. It depends. Depends on a lot of things. So let's peel back the layers of the onion and let's look at a few more factors. We want to know the index. That's number 2, the index. What is that adjustable rate tied to? What makes it move? It doesn't just move arbitrarily, right? It has to be tied to some index, some economic indicator. And there are many different indexes used. We all know from years ago, and we did shows on this years ago, about the LIBOR scandal, right? That was a common index used for adjustable rate mortgages. The London Interbank exchange rate, or whatever it is, I can't remember. But anyway, the LIBOR was a common index, right? Or the London Interbank Open Rate, I think is what it stands for, something like that. So that is an index. And when the index moves, it makes the adjustable rate mortgage move. So start rate, index, we've got two. Three more major components. The margin. The margin is what determines your ultimate rate that adjustable rate mortgage is paying, because it is the index plus, you might call it the lender's profit. It's not exactly that, but kind of. And so the index plus the margin, what is the margin? If the margin is 2% above the index, and say the index is at 4%, and the margin is, well, it'd probably be more like 2.5%. It depends on the loan, though. And say the margin is 2.5%, then the ultimate rate is 6.5%. Index plus margin determines interest rate on the mortgage you pay. So 4% plus 2.5%, 6.5% is the ultimate rate. But that is limited on how much it can go up or down, because many times there will be an interim rate cap. What is that? Well, when does that adjustable rate mortgage adjust? Does it adjust every 6 months or every year, right? So it's in the loan docs. It is shown when does it adjust, right? 6 months, annually, whatever, right? Say it's annual, for example. So if the interim cap only allows it to adjust 1% annually, for example, and say your start rate is 5%, then if the index plus margin says your rate should be 6.5%, but the interim cap only allows a 1% annual adjustment, it can't go above 6, because it went from 5 to 6, that's it. Even though the index plus margin says it should be a half point higher, it is limited by that interim cap. Also, and we'll just go to the next one, the fifth major component. There are other components, but these are the major ones, in my opinion. The lifetime cap. So what is the overall cap on the interest rate over the life of that adjustable rate loan? And so that might be, maybe an example would be like 5% above the initial start rate. So if you start at 5, then the highest it could go is 10%. For example, right? Now, I want to go back to the interim cap for a minute, item number 4, because the interim cap can also hurt you. It can limit, in a declining interest rate market, how much the loan can go down, right? So sometimes it's written where if the index plus margin determines that your rate should fall, and they do fall, by the way, adjustable rate mortgages do go down in price, happens all the time, okay? It can limit how much it can actually fall. It can't fall more than 1% a year in that example I gave, or it can't rise more than 1% per year in that example I gave. So just understand these 5 major components: start rate, index, margin, interim cap, and lifetime cap. Now, there are many other factors, of course. How many points do they charge? Which index is the best? A lot of factors. Talk to your lender, talk to us, talk to your investment counselor to help you through these things. But I wanted to just give you a very basic education on adjustable rate loans, adjustable rate mortgages. Those 5 major factors I think should be very helpful to you. I want to say thank you to all of our investment counselors and our team who put together a fantastic Empowered Investor Pro Zoom meeting just last night on hybrid self-management. We had a great guest speaker, and she went over a bunch of things of how you can handle tenant turnovers remotely, how 72% of all of the investors in the real estate market do not use a property manager. Most people self-manage, right? Or they do our hybrid self-management approach, which we really think is the best approach, where they're not completely self-managing, but they're doing it in a hybrid way. And if you're not a member of Empowered Investor Pro yet, well, let me tell you, you're just crazy. You have got to become a member of our Empowered Investor Pro and join us for our monthly Zoom meetings. You will get your money back a zillion times over. Don't quote me on that. It's not an exact number because a zillion doesn't exist. Okay, anyway, you will get your money back over and over again if you participate in our monthly Zoom meetings. You have access to our social network, use the archive with all sorts of education. All of our past meetings are in there. It's just an incredibly good value. So Empowered Investor Pro, ask your investment counselor about that. Go to jasonhartman.com or empoweredinvestor.com and be sure you take advantage of Empowered Investor Pro. Get in a network of people that can help you further your investment success, and our monthly Zoom meetings will really help you with that too. All right, that's it for today, folks. I've got to get on with the cruise here, and next I will probably be talking to you from either Bratislava in Slovakia or maybe Vienna, which is one of the most beautiful cities in Europe, in my opinion, but hey, they're all so beautiful in so many ways. So until next time, we will see you soon, and happy investing.